Okay, so we're going to be going over capital budgeting. I'm Craig Kingsbury.
And my name is Mohammed alhajri.
Okay. So capital budgeting is the process of making capital investment decisions. These capital investment decisions include acquiring capital assets. Capital assets are used for long periods of time. Examples of these capital investment decisions include new equipment, building new plants, automation production, and developing major commercial websites. There are four main methods of capital budgeting analysis. The first two, payback period and accounting rate of return, or ARR, are fairly quick and easy to calculate and work well for capital investments that have relatively short lifespan, such as computer equipment and software that may be useful in only 2 or 3 years. The payback period provides management with valuable information on how fast cash invested will be recouped. The ARR method shows the effect of the investment on the company's accrual-based income. So the other two are net present value (NPV) and internal rate of return, which Mohammed will be going over after I explain the first two. The capital budgeting process involves 5 steps. The first step is to identify potential investments, such as new technology and equipment that may make the company more efficient, competitive, and profitable. The next step is to estimate future net cash inflows. This is done to the best of the manager's abilities based on all relative information they have. The third step is to analyze the investment using one of the 4 methods previously discussed. This step can be broken down into 2 stages. The first stage is to screen out undesirable investments using the payback and/or ARR. The second stage is to further analyze the investment that made it through the first stage by using either NPV and/or ARR. This leads to the fourth step, engaging in capital rationing, if necessary, to choose among alternative investments. The final step of this process is to perform post-audits after making capital investments. With this, they compare the actual net cash inflows generated from the investment to the projected net cash inflows. Okay, so the payback period is the length of time it takes to recover the net cash inflows, the cost of the capital outlay. Basically what this means is the amount of time it takes to recover their initial investment in dollars. The shorter the payback period, the more attractive the investment. The equation for the payback period is the amount invested over the expected annual net cash inflows. There are a lot of criticisms of the payback period method. One of the criticisms is the method only tells management how quickly it will recover its cash. The other is investments with the shortest payback period is best only when the other factors are all the same. Basically, this means only if all the amounts being put into it and taken out are the same. The third is outweighs initial investment recovery over investments of total profit. So basically, if during the payback period one makes it back faster and makes more, but in the long run makes less than the other one, it will choose the one that makes less money. That's one flaw. The final flaw is it's most beneficial as a device to weed out investments that will take too long to recoup. So it's not a very good technique to find an actual investment that's going to pay in the long run. It's better to just weed out investments that you know won't be profitable in the short run. The last thing I'll be talking about is the accounting rate of return, or also known as ARR. The ARR measures the profitability of assets over its entire life using accrual accounting figures. ARR helps managers see how the investment will impact their decision's profitability. Both of these methods, payback and ARR, are quick and simple to compute. However, they do not create a full picture of the investment in equations unlike NPV and IRR. The equation for the ARR is average annual net cash inflow. Average annual net cash flow minus the annual depreciation expense over the initial investment. Now I'm going to turn it over to Mohammed.
Now I'm going to talk about the discounted cash flow model. The discounted cash flow models are net present value and internal rate of return. What makes them different from the payback method and the ARR method is that they include the time value of money. Moreover, the NPV and the IRR use the present value calculation to compare the initial cost of the investment with its expected net cash inflow. The NPV compares the value of dollar today to the value of the same dollar in the future. taking inflation and return into account. Furthermore, it allows managers to make an apple-to-apple comparison between the cash flow they will receive in the future from the investment and the initial cost of the investment. The NBV is used to decide if the money that they will be invested now is worth more, or whether the cash inflow from the investment in the future is worth more. To calculate the NBV, when you have equal annual cash inflow, you multiply that amount with the annuity factor. If you have a positive NBV number, then you should invest. However, if the NBV is negative, you shouldn't invest. When we have an equal annual net cash inflow and we want to calculate the NBV, we calculate each year NBV. The profitability index is a useful tool when companies have more than one project that meet their investment criteria. It computes the number of dollars returned for every dollar invested. In order to calculate the profitability index, we divided the present value of net cash inflow over the initial cost of the investment. The IRR is the rate of return a company can expect to earn by investing in a project. Moreover, it is the interest rate that makes the cost of the investment equal to the present value of the investment cash flow. To calculate the IRR when we have equal annual cash inflow, we divide the investment initial cost over the annual cash received. If the IRR exceeds the required rate of return, we invest. However, if it's less than the required rate, we shouldn't invest. When we have an equal cash inflow, we should use the trial and error procedure to determine the discounted rate that make the investment equal to zero. Now for our project, we have been asked to pick a two-car model from the same manufacturer, and one of them should be a hybrid and the other one should be non-hybrid. So we
chose the Porsche Cayenne, and they had both the same model and the hybrid model and non-hybrid model, and we took the cost of each one. The cost of the non-hybrid was $47,700, and the cost of the hybrid model was $67,700, a difference of $20,000. We then found the average miles per gallon for each one. The non-hybrid got 22 miles per gallon on average, and the hybrid got 24 miles per gallon on average. We then calculated the total gallons per year that that each gallon would use based off the average miles driven per year on the average American, which was 13,476 miles per year. So the total gallons per year in each model would be 612 on the non-hybrid, and then 561 on the hybrid model. We calculated the cost of gas based on 417 per gallon, and the cost per year for the non-hybrid would be 2,554, and the hybrid model would be 2,341.
After that, we calculated the MBV using the cost of gasoline for 10 years period, and the interest we use is 6%. So the hybrid car, the MBV for the hybrid car is 84,954, and the non-hybrid is 66,500, which gives us the difference, which is 18,454. And in order to pay the 20,000 difference between the hybrid and the non-hybrid, it will take us 95 years to pay that amount, using the saving from gasoline per year if we buy the hybrid car. And the quality factor that might affect our decision is someone might prefer the hybrid, even so it costs 20,000 more, and it will take him 95 years to pay the difference. If that person is into the green environment or supports that green environment that saves the planet, he might buy the the hybrid car over the non-hybrid. Other reason, maybe because the gasoline prices is going up the next years. So that is one of the reasons that someone may consider buying the hybrid over the non-hybrid.
Alright, so we want to thank you for listening to us. This is Craig and
Mohammed.
alright, thank you. Bye.